Thank you. Hi, everybody. Welcome. It's nice to see you all. Just super quick bit of housekeeping first. We do want to make this interactive. So as we're going through, please feel free to raise your hand, ask questions. Just give it a second, though, because we'll want to bring the mic over so that folks who are joining us online can hear as well. Okay. So thank you for joining us. We are going to talk about understanding what is happening in the market today, how that's affecting fundraising, term sheets, and all of that good stuff. So I'll let Colin introduce himself first.
I'm Colin Kirby. I've been a venture attorney helping predominantly companies, also investors in venture-backed, growth-oriented companies for 10 or 11 years. I've taught a few venture investing classes. I've made a few venture investments of varying success levels. And I'm one of the rare attorneys that doesn't like talking about themselves. So I think that's enough.
I mean, that was pretty good.
Okay,
So,
good.
I am Lynn Zagami. I am a recovered attorney, also the head of customer success at Shoebox. We are an equity management platform that startups use from after incorporation up through an exit IPO. So I lead our client services team, help a lot of our clients in preparation for fundraising, coming through a fundraise, what happens afterwards, and all of that good stuff. So there's a lot of people in the room, which tells me that a lot of folks are curious about kind of what's happening in fundraising these days, how changes in the market are affecting term sheets, investment rounds generally. But we know startups are still getting interest from venture investors, angel investors as well. So really what our goal is going to be today is to help you understand the essential principles to know along the way through your fundraising journey, along with an understanding of more investor-friendly deal terms that are kind of starting to reemerge that we haven't seen in a while. So our goal will be to arm you with that information, make you more savvy as you're heading into your fundraising preparation, and want to make sure that you feel more comfortable approaching your deal, understanding those terms. And as I said, please feel free to raise your hand, make this interactive. All right, so let's dig into what is actually happening today. Kind of need to understand how we got here, how things have changed. So let's go back to, say, early fall 2021. What did your world look like then?
Yeah, so I think this is a helpful place to start because I think where we are maybe isn't as bad as I've heard in board meetings and as some, pundits, I think would have you think, at least with respect to venture capital. Fall 2021, really all of 2021, I've never seen a pace of deal making in 11 years, anything like that. I had multiple clients that were raising money 6 and even 4 months apart with no real progress, like on the revenue side, but raising at like double or triple or 5x the valuation. It was just a matter of investors really wanted a cybersecurity company or whatever the sector du jour was. So an incredible amount of competition among investors for deals and an incredible amount of FOMO on not getting them. And I think founders knew that. And again, especially the valuation pieces were going up without any real explanation. And I don't know. I don't know that we need to go back there. I think right now, we're a little bit closer to earth, and there's usually some financial either top line or profitability backing to the valuations. We aren't just picking them up out of the sky.
Yeah, absolutely. So now here we are, early fall 2022. Let's talk a little bit about what's changed, what the forces are that are driving changes when you're working with portfolio companies, potential portfolio companies, and clients, people that you are coaching kind of in preparation and going through their deals. What's different now?
So I think, again, there's some, I don't want to say it's fundamentals, because I think at the very early stages you shouldn't really be overly concerned about how you're going to be profitable in a few months or whatever. But there's a level of rationality in when and why companies are being funded. What I see, and my partners are seeing this too, is there are two things: stage and sector. You still see deals happening, and deals happening relatively quickly at seed, pre-seed stages. Think like, if you're not yet in the market, and it's, software companies are not very capital intensive, in the right sector, we're still seeing a lot of availability of deals. I think that's also true in the like B, C, sort of the hot, well-established venture company, if you will, where there's still heavy amounts of competition for, for access to their cap table by investors. I think the trickiest part is really in the middle, and I think that's where we're seeing the bulk of some of the more onerous terms that we'll talk about. I think once you're in the market, you're now trying to capture market share. It's a riskier proposition for that stage investor, and I think ironically, there's a lot of seed cash available, and there's a lot of cash at a later stage. The Fidelities or whoever else in the world, they need to put that capital to work that's going to be available. Again, it's that sort of middle stage. So again, that's the stage. The sector, you're seeing pure software and enterprise plays still getting funded relatively quickly and easily. We see some of the like pie in the sky. I'm thinking of an underwater hotel pitch that I listened to in the bulk of all this, that I haven't checked in on them, but I'd be surprised how much funding they've
Isn't
got.
that just Atlantis?
I think there's a whole plan for both on Earth and off Earth type, tourism's big. So yeah, I think some of the pie in the sky. I think also like, which is almost too bad in a lot of ways, like the Impossible Foods and the Beyond Meats, like those sort of just capital intensive, going to be continually capital intensive things are just a little bit slower to mature. So yeah.
Would you put hardware in that bucket as well?
Yeah, I mean, I think every hardware entrepreneur can spin it as a software pitch, maybe. And I've seen that done in a lot of places. I've seen that done in cybersecurity a lot of places. But yeah, I do think hardware is sort of a more scary word than we're a SaaS-based enterprise company. Yeah.
And just so we're clear on terminology and folks in the room are familiar, when we're talking about a seed deal or pre-seed versus A versus B, C, are there kind of ranges of dollars that we're talking about for those deals that folks could use as a guidepost?
Yeah. So I'd use dollars, and I'd use the identity of the investors. So, I mean, every, especially attorney on earth, is going to say there's no strict, rule in one state. But roughly $1 million, I feel like, is when you're sort of moving out of the pre-seed into like the seed. I also think, when you're moving away from either friends and family or different high net worth investors to more institutional entities that invest primarily in growth oriented companies, where that's their job is, that is when you're going more towards like a seed as opposed to like a pre-seed or an angel round.
Yeah. And then when we're talking about A, that would be more exclusively venture capital and those folks.
Yeah. Yes. When I started doing this, whenever someone said, "Oh, well, when I started," I'd sort of roll my eyes. And now I'm saying all those dumb cliches. But back when I started, a Series A was $4-ish million round. I mean, I've seen Series A's at 10x, for 40 on a whatever, 120, 160. And so, I mean, we're all just calling it different things. What used to be an A is a seed. What used to be a seed is a pre-seed. But yeah, I think at Series A, you're usually squarely dealing with an institutional investor. And that doesn't necessarily mean a ton of institutional capital. It can just mean a seed player that invests in growth-oriented companies as their main gig.
Yeah. So when you're working with clients now, and I know you have some funds as clients, but the vast majority of your client base is companies that are out there working with existing investors, courting new investors, and kind of everything in between. So how has your guidance to those clients changed over the last, let's say, 3 to 6 months? Let's start with the folks who are planning for, let's say, their first institutional round.
Yeah. So I think that, first of all, I've heard a lot of doom and gloom from, especially a couple months ago, from institutional investors in the boardroom, that, these are funds that pitched founders on, we're always going to be there. We're the real different capital, that then, the market goes down 20% and they're like, just so you know, don't depend on us for any more capital. Like, we're not going to always be here. It's like literally the opposite tune of what they were saying when they were competing for a term sheet. That said, I think some of it's a little bit overinflated, and B, I still think there's like opportunities for these founding teams. And I think, for those who recently raised funding, you can really hyper focus on executing. And I feel like CEOs get caught in this web of, I'm raising money, I just closed, I'm raising money, I just closed. And to be able to like pause, blend with the team, try and work on the product. I think that's a nice breath that, too few, I think, founders get to sit back and do. I also think, in terms of like changes on guidance, tailoring pitches to maybe market realities. There was this adoption of like, yeah, I'm totally okay investing, and I know that you have to raise more capital from somebody else in 10 months. I think there's maybe less comfort with that sort of pitch. And if you can find a spin that's like, we're profitable here, maybe we raise more capital, maybe we don't, and trying to sort of risk adjust, I think there's a good deal of benefit in that. And yeah, I'll leave it there.
So if you're talking to clients that are, already around in the door, kind of thinking about follow on, whether from existing investors, new incoming investors, kind of a combination of both, how's your guidance with those folks changing? Are you seeing different concerns with them, or are they a little bit safer now
at the later stage?
Yeah.
So those who raised, I think, are in a good spot, because hopefully they've got a year of burn on their books and they've got a little bit of flexibility. I got a term sheet yesterday that this CEO was sort of able to laugh at, and there was a lot of issues with it. And, to see an available 150 million of capital that, that didn't need to take, I think he was happy he had the optionality. But I think, like, if you don't have that sort of that very clear 9 to 12 to 18 months of runway, I think you sort of do have to prepare for fundraising, and it's sort of a crapshoot how long that can take. I mean, for the like more well-heeled startups, and this came off of this investor. This was in one boardroom where the investor just said they're not going to be around, and then I suggested they look for acquisition opportunities, as in buying other companies, which I don't think anyone with any investors really appreciated in the room. But you can find these companies that have been around for, they did a Series A in 2018, sort of been flat since then. Good tech team. I mean, there's maybe some bargains that that you can find in terms of acquisition activity. We haven't seen as much acquisition activity in that sort of middle market opportunistic space, though. So
yeah, so the companies that are up and running, not blowing up, but perhaps a competitor that one of your clients could swallow up. Yeah,
exactly. And like different companies excel at different things. Like maybe your tech is way ahead, maybe your sales is way behind, maybe it's the other way around. One way to fill that gap, and we used to do this like in the beginning of the 2010s a bunch, is to make a little acquisition of a 30-person company. And it's an easy way to sort of get the talent and some tech.
Yeah, no, makes sense. So I want to dig into the specifics a little bit. So when you're thinking about clients who are going out to fundraise and are preparing for 1, 2, 3 term sheets to come across their desk, what are you telling them to prepare for that is kind of different from what they might have needed to brace themselves for a year or so ago?
Yeah, so I think especially at the early stage, and is everyone here like, if you've raised less than like $1 million, less than $2 million, okay, yeah, like I less than $10 million. I think we saw so many convertible instrument rounds as the first capital in there. So companies raising $1 million, $2 million, $3 million with only either a convertible note or a safe, basically delaying the valuation and figuring out, okay, what percentage of my company is taken by that 1, 2, 3 million? You don't know. But we saw what I thought were crazy terms where there'd be a $50 million valuation cap on that, meaning like it could be as small as 2%. Like it could be very, very small, depending on what the next capital raise is. I did a $50 million cap round with no discount, meaning it just converted into the later round. And I think those are gone now. In their place is I did in the last 3 weeks, I've done 3 priced seed rounds. Price round meaning someone's buying stock. They're buying a very specific percentage of the company. And I think that's good for both the investor and the founder. There's some assurance at what percentage that amount of capital is taking off your cap table. And there's ability to like move forward without these contingencies about when the investment converts. And this is also something we're seeing like across our group, more priced rounds as opposed to convertible rounds, where again, like there's a firmer structure to what deals are happening. So I think going out there, especially if you find a lead with a price round and just absorbing 10-20% dilution and maybe a single digit pre-money valuation is a good way to just get off the ground with the fundraising. I'd say one other thing. The kind of capital you're taking, I think there was for a long time a lot available, and you were able to sell to the highest bidder, and you could sort of go after a very aggressive high valuation, take very little dilution. The thing I impress upon founders and everyone in this room now is it's a cliche, but it's a cliche for a reason. Finding the right partner, finding the most value add person to put money in your business. And sometimes that partner is not going to have the right amount of capital. And I think that's okay. Sometimes they want to invest more than you're comfortable with, sometimes less. I think you adjust and find the investor you trust, as opposed to taking money at the best price and not knowing in 6 or 12 months like what the world is going to look like. And again, you hear it a lot, but I get to see the other side of this. I get to see Uncle Bob, who put $500K in a company, demand that he gets his money back in 2 years, even though, this is an illiquid investment. And the more you can find, there's also there's non-capital reasons to invest with folks. And that doesn't just necessarily mean strategic investors. That also means investors that have helped similarly situated companies grow from one place to another, before. And I think one good thing that I think two founders don't do enough is do reference checks on the investors. Like, go to the last couple portfolio companies. Founders are usually happy to talk about that stuff. And especially if the company's already exited, you're going to get an honest answer. And yeah, I think that's helpful.
Yeah, the investors in my last company also recommended talk to one of the founders whose company didn't have a successful exit, right? What did that investor look like in the boardroom when things weren't going so well?
Yeah, exactly. And I actually think it's more valuable than the one that sold for $1 billion in 3 years, because
Everybody's happy.
Everyone's happy, right? And that's it's funny. The easiest deal I've ever done was $1.26 billion, all cash deal. There was literally so much cash around that nobody cared about any of the issues, which for the lawyers is awesome. It's yeah, everyone goes home at 6, right? The one of the worst I've ever done was an $8 million asset sale because there was no money there for anyone. But yeah, finding, and also companies that took a long time between fundraising rounds, because that's sort of this dearth or scary period that you've got to survive. Yeah.
I want to go back to the sort of priced rounds versus safes and convertible notes thing for a moment, because I think this is, so I mentioned in the beginning, I'm a recovered lawyer, completely stopped practicing about 6 years ago when I joined Shoebox. The safe on the East Coast was not a thing yet, right? So it was coming from California, becoming more popular. Now it's literally everywhere. People run that workflow on our platform about 3 times as much as they run the convertible note one.
Interesting.
Yeah. So many, many more millions of dollars raised that way from our clients. So yes, there's some, accepting dilution, having more certainty around, okay, Acme Fund is going to have X percentage of our cap table or whatever. But those deals typically, right, take longer to put together, are more expensive in terms of legal fees, in terms of time and energy required of the founders, because you've got more diligence and preparation that needs to happen. How are you does all of that kind of come out in the wash when you're talking about priorities around cap table certainty?
It's definitely relevant. Safes are super easy to do. They're 2 pages. Now there's a form of a pre-money and a post-money safe, which is a little annoying. But aside from that, nothing's idiot proof, but it's a much easier, more streamlined way to raise. And I think if you're raising, certainly something from an individual in 5 digits, you don't want to do an equity round. An equity round is more or less in stone. Very set terms. You can't sort of go back and change everything. If you're cobbling together a number of different smaller investors and you don't yet have a lead, a convertible, a safe round makes a lot of sense. If when you have a lead and you can sell it, and when I say sell it, I mean sell your lead to other potential investors. So the lead wants to take 1 million of a $2 million round, you'll fill out that round, no problem. There's something to be said for the certainty of an equity round. And I would also argue that the terms, they take longer to prepare, but we're talking about 2 days or 1 day. A good lawyer can do it in a couple hours, but
also automate them. But we can talk about that later.
Pretty soon the robots will be here to take my job.
We're here.
We're talking about a day or 2 in preparing documents, as opposed to a couple minutes of doing it, and it can be really worthwhile. And I'd say that the terms in seed financing are so firmed up from a market perspective. There's not as much ambiguity or sort of middle ground on terms as you'd expect. Invest in $1 million, fine, you get a board seat. like you do 2 founders, one board. You get non-participating preferred. Then we can go through some of the more aggressive terms we're seeing, but you're pretty assured, a handful of really firm terms that will not be too heavily negotiated.
Yeah. So let's talk about the terms that are standard and where we're seeing things start to creep towards a more investor friendly side, right? I mean, we've been talking for years and years. Participating preferred, it's double dipping, it's terrible, nobody does it. My team, when we're looking at client fundraising documents, thinks there's something wrong when they see participating preferred, because we very rarely do. So where is that creep happening? Where is it not happening?
So I can do worse. We did a little poll of our associates, and we had a 6th-year adventure associate who had never done a down round, like never. And these are associates
that must be nice.
do, she's probably done, 100, 150 financings and never done one down round. So yeah, it's a whole new world out there for some of them. So some of the terms we're seeing, we're seeing a little bit of the participating preferred. I haven't seen a ton of it. Some of my partners have. I'm seeing like dividend rights. So this like accruing 6, 7, 8, 9% dividend that comes on top of the investor's money. Now, I think all the investors say, well, there's inflation and we don't know what's going to happen. And I tell the founders to say, why is that my fucking problem? Like it's something we all have to deal with. But that can be really onerous, like twice annually compounding 7, 8% in like 4 years, 6 years, that's 2x. And coupled with that I've also seen, and this is my most loathsome term, you can tell I do more company side work. It's always, us against the big guy. But the forced redemption, right, where in 5, 6 years, the investor can come with their stock to the company and say, here's my stock, pay me 1x that I invested, or pay me 2x what I invested. And that can be crippling. That means you're looking for an acquisition 2 years or a year after you raise capital. And I can say this publicly because I tell investors that I don't think it's in their best interest to get that term. I think you're putting too much pressure on the company from a market perspective. Any other investor is going to be nervous about putting money into a company if there's a call right in 3 years on capital coming out that, if called, would put the company underwater. So it's not ideal. You see this redemption right when the life of a fund is expiring. It also falls in the why is that my problem department. Like, you as a founder shouldn't care about the life of the fund within reason.
Yeah. Are folks familiar with sort of how that works out, the investment period for a fund, how long the funds last and all that good stuff? Should we dig into that a little bit? I'm going to say yes. So let's talk just sort of broad overview of how the funds are, have certain periods for investing, dry powder, which I'm sure folks are hearing about in the news, how that all works when founders are planning to raise capital.
Yeah. So in theory, there are limited partners that the funds have to answer to. I mean, the funds have investors just like the companies have investors, and they will seek a return within a reasonable period. I mean, the difficult thing in venture and really predominantly in venture is you just don't know the period of time, and that your investment's going to get liquid. And everyone on your cap table who is an investor, but really everyone, including your management, needs to know that there's no assurance that your share of stock or your stock option is going to be liquid ever. And people will get antsy. Investors, more green investors, will get antsy around that. I've never found the expiring fund is a very compelling reason, because look, you're investing in a company, you're believing in the founding team. The way you manage your business is sort of your business. Like, the founder isn't supposed to be an advisor to the investor about how to manage the fund. It's supposed to be the other way around. So
yeah, that makes perfect sense. The we dug up a little quote from VC Twitter, which is always a fun place to be. Rob Go from NextView sort of hypothesized that the way that we're going to see kind of the next, let's say, 6 months, year, 2 years of fundraising go is we're effectively going to see the market split into 2 camps, right? There's going to be a camp for these so-called in-network founders who have some sort of indicator, right, that they're likely to succeed, whether that's schooling, whether that's their network, whether that's where the company that they came out of that might have had a successful exit. Those guys are going to do just fine. And I say guys on purpose. Then there's going to be everybody else, right? And what we're going to be looking at there is harsher deal terms, deals that take longer to close, more aggressive diligence, smaller checks potentially as well. So I'm curious kind of your reaction to Rob's theory, if you're seeing that start to emerge with your client base, if you think it's total bullshit.
no, 100%. I think it's already happening. I don't know Rob. And I think it's already happening. I don't know how insightful something that already happened is, but like, you're already seeing sort of the have and the have-nots. And it was interesting when I saw this quote, because he sent it to me. I didn't think of the underrepresented part, and I've been thinking about it for 24 hours, and I think it's a real concern. I think that might be where it lands. I think that there's I have too many well-funded clients with a very similar looking board. Let's put it that way. So I sort of put the onus on investors to continue on these missions. Like, it's easy to say that you are going to take a certain position and have a certain level of priorities when everything's going incredibly well. Look, I mean, I think, but to underscore, and I guess sort of where we started, I'm not sure the doomsday scenario, at least in venture, is here yet. There's a great bet, and I was talking to another CEO that was considering going public sort of towards the end of the bull market cycle, and he was very relieved that he didn't, because every public company got a 30% discount, especially the ones that were newly public. And it's interesting. I thought all of my clients would be coming to me and saying, we have to reprice our stock options. They're probably underwater. I think rightfully, a lot of founders don't want to send the signal to management that the company's at a lower place where it was. But also, for the haves, you haven't seen the dip in valuations that the public markets have absorbed. And, who knows how rational that is. But, again, I go back to speaking to my buddy yesterday about sort of laughing at a term sheet. It's great to be in that position. And, there is concern that the have-nots haven't been there. So we'll, keep all the investors' feet to the fire about, doing what they said they were going to do.
Yeah, I like that plan. Questions from anybody else? If anybody was holding off until the end, you do not have to. Just making sure that
there were a few questions online. If you wanted
shoot.
to.
Yeah, go for it.
So there was when you were talking about the safes, someone was asking, are safes dead right now at all? Generally speaking?
They're not. They're safe. How can they be dead? No, we're seeing safes have really supplanted convertible notes as the early stage. Convertible notes used to be like bridge financing. Right before a financing, you need a little bit of capital to get you through. The note, you get a little discount on your money. The the note would convert into the next round. SAFE sort of supplanted that and made a convertible fund be better able to stand alone as its own investment round. So, you know, you can raise $1 million, $2 million on SAFEs. Now, where I caution founders is I'd be weary about doing too much more than that. It's tough to factor in how much dilution you're actually absorbing, because I saw plenty of companies that did 3 SAFE rounds, all at different valuation caps or all with different discounts. And, you know, it's, you can do one big Series A, and if you're lucky, you get away with those SAFEs being 40% of your cap table. Oftentimes they sit out there for a long time, because the burden to which the amount of capital you have to raise in order to convert them just keeps going up and up and up. And that's sort of regardless of the contractual terms in the SAFE. You should always be raising the dry powder capital, the actual cash, equal to at least, I think, the amount that you're in the hole on the SAFEs. But SAFEs aren't debt. They exist in another atmosphere of securities.
And there's a couple others kind of clarifying questions. So someone was asking about convertible notes. So is a 20% discount still standard, or any other percentage discounts or caps that the vehicle's evolving into?
Yeah, I mean, that's a good question. I mean, I think that 20% departed temporarily from the standard, and it became 15 or 10. And now I think we're back squarely where 20%. By the way, I think it's a very fair term for an investor. Oftentimes that convertible is coming maybe a year, 18 months before a fundraising round. Yeah, 20% return is great, but it's illiquid, and it's a seemingly fair trade. I would caution on any meaningful interest rate. Maybe you can go up a little bit further north. We would rarely see them above 5-ish, 6-ish%. Maybe you can go a little bit more north for the inflation piece. I mean, another sort of retort to that is, if you can get 6% on the market, go get 6% on the market. Like, this is not an index fund, right? This is not Fidelity. This is a riskier investment, more liquid investment.
And then for option pool targets per round, right? As you think about extra levels of financing later stages, what is a good balance to have, and what do you want to share with that investor to make sure you're hitting that target in the cap table?
Yeah. So, great question. I cannot underscore how much the option pool affects dilution in a fundraising round. The same person was laughing at the term sheet about the investor was proposing a 10% option pool at a company where I think 60 people in management already have equity. Now, that tells me that either the CEO is terrible at hiring, or the investor didn't do enough diligence on what they were looking at, because you don't need 10% of your company at that stage to have for new hires or to true up existing hires. That's not, I mean, at the seed stage, the angel stage, you very well may need that amount. You might need more. What you should be setting option pool is, here's the answer at the end. Whatever's going to get you either to your next round of fundraising or at least a year. You don't want to turn back after someone just put money in your business and say, okay, you raised that, X valuation, but we actually need to open the pool and dilute you by 5% on day 90 of your investment. You want there to be enough buffer to handle all the hires, including the pie in the sky hires for the next 12 months, but not much beyond that. The idea being at every fundraising round, you're going to re-up your pool. And just like very, very quick math, if I'm asking for a 10% pool, I'm actually asking for more like a 15 or 20% pool, because I'm asking for that 10% pool after the capital comes in. And when I was running the numbers for this one term sheet I was looking at, I deleted it, and ended up being a down round by about 20%. I deleted the option pool and ended up being an up round by 20%. It can really dramatically affect the price and the amount of dilution you're taking. The investor is taking without regard to the option pool. The investor is going to get the same stake that the investor wants, whether that's 12.5%, which is I think what a lot want, or 10 or 8, or whatever. They're going to get it counting that pool. So, they actually have more of the company the bigger the unallocated pool gets. The inverse is true for everyone else on the cap table. There's only 100% available. I've also run into that a few times.
We wanted to see if anyone else here in the audience. I'm happy to bring the mic over. That way people at home can actually hear you ask a question.
Hey, thanks. So talking about expiring funds, is that something that we should be looking out for in the term sheet, or is that something that can be thrown on us 24 months in and we don't know what to do?
No, I think it's something. So there's a lot of resources about how old these funds are. Crunchbase is a really good one. It's something you can, if you get a term sheet, look into independently of that. It won't exist. It won't say, well, let me put a pin in that for a second. You'll be able to research like how old is their fund? Are they raising a new fund? Raising a new fund, you're a little bit less concerned about that. Not raising a new fund could mean, that they're retiring. It could mean that like they don't have the returns to do it. But you can sort of look at, and there's a lot of publicity around raising a new fund, just like doing a new round of financing. You can see it's sort of the length of the fund, the age. The redemption thing is the closest thing that will exist in the term sheet to a concern around that, which is, and it always comes at the end of the term sheet. And if it's there, and it'll say that in X years, I get to come back and demand my money back for my shares, and you company have to disgorge capital to pay me back. So be wary of that. If it is in there, call me. If it's not in there, you should call me anyway.
So I think we have time for about one more question. Because there is another one online as well. Anyone in the audience have? Yeah.
What's your take on doing a bridge round? I didn't hear that get brought up today. Specifically doing a convertible or a safe after a priced round has already been completed.
Yeah, I dealt with this last week. We had an oversubscribed seed raise. The founding team basically on 3 slides raising 1.5. Yeah, 1.5. And there was demand to more investors wanted to come in, or more capital for the investors that were there. And sorry, I'm like hashing out your question. I will get to it. And the founding team did not want to take more dilution. It's a nice problem to have, particularly in this market. And one solve for that, if there's the appetite on the investor side, is to say, look, we're only going to take this 1.5 million in equity. We will accept a 100, 200, 300K convertible or safe that will really be priced based on the next round. And then the trick is like, how do you define the valuation cap or the terms at which the discount at which that safe will convert? It's very strange. Like this one, we did a safe like 4 days after the deal ended, which like I think would have made a securities lawyer. I mean, like lawyers get nervous about everything, but would have made a securities lawyer nervous a couple of years ago. It's much more routine to answer your question. Oftentimes seeing, okay, we'll just put more money in. The investor will say, we'll just put more money in, not knowing the valuation, and a founding team being comfortable that that will be a less dilutive amount of capital, so they're willing to take the extra 500K that they couldn't place into the equity round. And I think the magic there is it depends on the investor. If you really want them, it's a good thing to think about. If it's less of a value add, I guess. You say, well, let me call you in 6 months and see how things are going. It's a really good question.
The one other question that was online was, kind of in a similar vein, why would a founder accept any redemption right, note in that particular contract negotiation term sheet?
Well, because they didn't listen to this. Yeah, I mean, it's a matter of how many options does the founding team have. I mean, look, the market is what the founder is able to take, and I get that as well as anyone. And you have to be realistic about if another term sheet is not coming for 6 months, that's either going to delay 6 months of your life, or is maybe your company or whatever your idea, your mission is changes. And if that's the difference between taking in the capital and it's that momentous, you can definitely explain away what happens. There's a way around all this, and you can oftentimes get the toothpaste back in the tube, but you just want to be careful about the signal you send to the market later about whether or not it's investable. I think the other thing you could accept is fine, we'll eat it, but let's agree that if things are going well, it disappears at the Series A. And I think doing that on a handshake is fine. That's another thing you don't hear a lot of lawyers say. But get some acknowledgement that it won't always be there.
Perfect. Well, we are just at our time here, so I just want to thank Colin and Lynn for participating in Startup Boston Week. So I just want to give you a round of applause. Thank you so much.
Thanks.